Welcome back to the Deep Dive. It is Friday, February 13th, 2026. And honestly, looking at the markets this morning, the date feels a little too on the nose.
It really does.
I mean, if you've opened your portfolio app or, God forbid, you've checked the sentiment on X, you know the atmosphere isn't just tense, it's heavy.
Oh, it's heavy. There's a specific kind of silence in the trader groups right now.
Exactly. It's that silence that only happens when people are down, significant money.
It's the silence of capitulation, or at least the fear of it. The screens are ugly. There's no way around that. When you see Bitcoin testing the $70,000 level after, what was it, 125,000 just a few months ago, the psychological toll is just, it's undeniable.
That's a 45% haircut from the October highs.
No.
And I think what's really rattling people isn't just the draw. I mean, we're used to volatility. It's the narrative shift.
The whole narrative.
We went from super cycle and new paradigm to it's over in about 12 weeks. But that brings us to the focus of today's dive. We found a report from OscarAI that's really pushing back against this doom loop.
A very contrarian take.
Very. The title translates roughly to, even if it looks like one, it isn't a bear market.
Okay.
And they use this analogy that I think perfectly frames our discussion today.
Okay.
They compare the market right now to a house party. Someone screams, fire, smoke fills the hallway, alarms are going off, and everyone just stampedes for the exit. They think the whole structure is burning down.
But it's not.
But it's not. In reality, somebody just burned a pizza in the oven.
That's a vivid image. So they're making a distinction between an environment that's just, temporarily awful smoke, panic, a lot of noise, and a structure that's actually compromised.
Exactly. In a real house fire, the asset is destroyed. But in the burnt pizza scenario, the conditions are terrible, sure, but the house is still standing.
So the report is basically arguing that we're all confusing the immediate pain with, a structural failure.
Yes. So our job today is to put on the hazmat suits, walk into that kitchen, and see what is actually happening. Is the house burning down?
Mm-hmm.
Are we in a terminal multi-year bear market, or do we just need to open a window?
But to do that fairly, we have to look at the smoke first.
We have to.
We have to acknowledge why the bear case is so convincing right now. You can't just dismiss a 40 or 50% drop as noise.
No way.
I mean, the raw data. The bears have a lot of ammunition. We're not just down from the peak. We've broken key support levels. And technically, a bear market is what? A correction of over 20%?
We're double that.
Yeah.
And it's not just Bitcoin. The altcoin market is just decimated. But I want to dig into the sentiment because the OscarAI report flags the fear and greed index. It's hovering between 5 and 9.
Single digits.
We haven't seen single digits sustain like this since the bottom of the last cycle.
And that level of extreme fear is so significant because of what it does to liquidity. When fear is at a 5, people aren't just selling, they're refusing to buy. The order books get incredibly thin.
Which means it takes way less volume to push the price down even further.
It becomes a self-fulfilling prophecy. We're seeing what some analysts are calling weekly capitulation.
I've seen those reports from CryptoQuant and Kaiko circulating. They are not optimistic. I think Benjamin Cowan was even mentioning a potential bleed down to the, $40,000 or $50,000 range.
Yeah, that's the range being floated.
That number 40,000, that feels like a psychological line in the sand. I mean, if we hit that, aren't we basically invalidating the whole institutional adoption thesis?
Not necessarily invalidating it, but certainly testing its limits. The bear argument here relies on market mechanics. We are seeing outflows from the ETFs.
The thing that was supposed to be the forever bid.
Right. And we are seeing whale distribution. Okay,
let's pause on the whales. Because whales are selling is a headline I feel like I see every single day. What does the data actually show?
The OscarAI analysis points to a very specific trend. It's in the wallets holding between 1,000 and 10,000 Bitcoin. Usually, in a healthy correction, you see these wallets start to tick up as price drops. They absorb the liquidity.
They buy the dip.
But right now, that line is flat or even declining. They're distributing into these little rally attempts. They are not stepping in to catch the falling knife. Not yet.
And that leads directly to the stablecoin dominance metric.
Yeah.
I feel like people kind of glaze over this one, but in this context, it seems like the most important chart to watch.
It is the most important chart for timing a reversal. It's basically a measure of dry powder versus invested capital.
Okay.
When investors get scared, they sell their crypto and they hold USDT or USDC. And right now, that dominance chart, It's parabolic. It is spiking, just vertically.
Which means everyone is just sitting in cash.
It means the market is de-risking at a velocity we haven't seen in years. It's a flight to safety. So you stack all this up, the price crash, whale selling, cash hoarding, the house fire theory looks pretty correct.
Okay, so that's the smoke. It's thick, it's choking, the alarms are blaring.
Hmm.
But now let's pivot. Let's talk about the counter thesis, the burnt pizza argument.
The other side?
The report references an analyst, Jose Luis Cava, and data from CoinDesk to argue that despite all of this, the internal structure is not bearish. How? How can they possibly claim that?
It comes down to looking at who is panicking. And this is the real crux of the not a classic bear argument. They argue that while the price action looks like a bear market, the internal market structure suggests more of a mid-cycle reset than a cycle end.
A reset, like turn the computer off and on again because it froze.
A violent reboot, yes. Look at the historical cycles. We are in the post-halving window. Historically, this is exactly when the market purges all the excess leverage before the real parabolic run.
Right.
Kaiko's analysis actually suggests we might only be halfway through this correction. But the most interesting data point in the whole report is about incomplete capitulation.
In the derivatives market? Yeah, I wanted to drill down on this. It says futures markets aren't showing the massive discounts we saw back in 2022. Why is that a good thing? I think we'd want to see discounts to signal a bottom.
It is very counterintuitive. In a true systemic collapse, like, the FTX crash or the start of the 2022 winter, you see this thing called backwardation.
Right.
It means futures prices are way lower than the spot price. Institutions are desperately paying anything to hedge or go short. They are panicking.
And we're not seeing that now.
No, futures are flat, maybe slightly negative, but we are not seeing that massive dislocation. And this implies that while retail panic is off the charts, the average person on X is freaking out, the institutional panic is muted.
So the big players are de-risking, sure, but they're not running for the exits with their hair on fire.
Exactly. The crowd at the party is screaming, but the folks who own the house are just standing in the kitchen checking their watches.
That's a great way to put it.
The institutions, they know how to weather a 40% drawdown. They hedge. They don't market sell the bottom. And this divergence between retail panic and institutional caution, that is a hallmark of a mid-cycle shakeout, not a terminal crash.
There's another metric the report brings up, supply and loss. It sounds terrible, but apparently it's a bullish signal.
It's a signal of seller exhaustion. When supply and loss gets this high, it just means a massive chunk of all the Bitcoin in circulation is being held by people who bought it higher than the current price.
The bag holders.
Or the strong hands, if they refuse to sell. Historically, when you reach these levels, the only people left in the market are the ones who are willing to just ride it out.
The weak hands are gone.
The weak hands, the tourists, the leveraged speculators, they've already sold. They're out. And when there's nobody left to sell, the price stops going down.
So we've basically run out of sellers.
Yeah.
That forms the floor.
Precisely. And you have to layer on the systemic maturity argument here. 2026 is just fundamentally different from 2022. We have the EPFs. We have regulatory frameworks that didn't exist 4 years ago.
It's a different world.
A completely different world. The argument here is that crypto is leading a global risk correction. It's like the canary in the coal mine for the S&P and the NASDAQ, which are softening, but they're not crashing.
So crypto is just reacting faster because it's on 24/7, no circuit breakers?
Exactly. It is the most sensitive liquidity gauge in the entire world. It feels the liquidity crunch first. But that doesn't mean the asset class is dying. It just means the liquidity tide is going out for a bit.
Okay, so we have two competing views. View A, the house is on fire, 40K is imminent, the cycle is dead. UB, it's a burnt pizza, institutions are calm, and this is a leverage flush before the next leg up.
Right.
How do we synthesize this? What's the verdict from the deep dive?
I think the verdict is that we are in a shakeout phase inside a larger supercycle.
Shakeout feels like a very gentle euphemism for losing a lot of money.
It definitely feels that way. But functionally, it's a cleaning mechanism. The market just became incredibly inefficient in late 2025. You had funding rates that were too high, way too much leverage, too much FOMO.
Right.
And the market is just brutally efficient at punishing excess. This drop is cleaning all of that out and resetting the baseline.
So the forest fire is burning the dead wood so new trees can grow.
Exactly. But, and this is the warning that you really need to hear, Just because it's a shakeout and not a terminal bear, that does not mean the pain is over.
Okay, yeah, the report was pretty clear that the bottom might not be in yet.
Correct. The burnt pizza analogy holds, but you still have to clear all the smoke before you can breathe again. We mentioned that $40,000 to $50,000 range. It is entirely possible we wick down to those levels to hunt for that final pocket of liquidity.
You need that final flush.
You need it. A true terminal bear market requires total capitulation. We haven't seen that final puke moment in the derivatives market, not yet.
The puke moment, very technical term.
It's the only word that fits. It's that moment where even the true believers click sell just to make the pain stop. We might need one more of those to get there.
Okay, so knowing that we are likely in this brutal but temporary shakeout phase, let's get tactical. For the learner listening right now, watching their portfolio bleed out, what's the play? The report gives a tactical guide.
The first step is psychological defense. You have to understand the math of capitulation. The source cites the statistic that it haunts me. Historically, investors who sell during the final 10 to 20% of a crash, they often miss the first 80% of the recovery.
That is just brutal. So you eat almost the entire loss and you miss the entire gain.
Because the bounce off the bottom is usually violent, it's V-shaped. If you sell now to save that last 15% of your capital, you are betting you can time the absolute bottom perfectly to get back in.
And the odds of that are
Near zero.
so sitting on your hands is the strategy. But we can't just blindly hope. The report gave us a specific watch list, 3 indicators to confirm a reversal. I want to go through these carefully so you know exactly what to look for.
Right. If you want to know when it's safe to go back in the kitchen, watch these 3 signals. Number 1, a reversal in stablecoin dominance.
We talked about this. We need to see that parabolic line start to crash down.
We need to see it roll over hard. We need sustained red candles on the USDT dominance chart. That confirms that capital is rotating back into risk assets. Until that line drops, any rally is probably fake.
Okay, signal number 2, funding rates.
This is all about the futures market. Right now, funding is probably flat or negative, shorts are paying longs, or nobody's doing much of anything. We want to see sustained positive funding rates.
Explain why. Why is it good that we have to pay to be long?
Because it signals confidence. Positive funding means traders are willing to pay a premium to hold that long exposure because they expect prices to go up. It shows the smart money is positioning for an uptrend. We need that heartbeat to come back to the market.
Got it. And signal number 3.
Whale behavior. We have to go back to those wallets holding 1,000+ Bitcoin. We need to see them stop distributing and start accumulating.
We want to see the green dots on those accumulation charts.
Exactly. When the whales start eating again, it creates a floor. It absorbs all the selling pressure from retail. So once you see stablecoins drop, funding go positive, and whales buying, that is your green light.
Is there a macro trigger? Something outside of the crypto bubble that could change this?
The Federal Reserve is the elephant in the room. The report notes that if we get a surprise pivot on interest rates or, some really positive regulatory news, that could short-circuit the technicals and trigger a rebound early.
But if the Fed stays hawkish?
Then we are likely waiting until Q3 or Q4 for the organic cycle to just play out.
That timeline Q3 or Q4 is sobering. It means we might be chopping around in this mess for another 6 months.
Which brings us to the most critical piece of advice in the report. Define your timeline. If you're a long-term investor with a 5-year horizon, these prices are objectively a gift. You're buying the scarcest asset on Earth at a 45% discount. But if you are a short-term trader,
Don't be a hero.
do not be a hero. Respect your stop losses. Do not try to revenge trade to make back what you lost in January. That is how you go to zero. If you need this money for rent in April, you really shouldn't be in the market right now.
It's the difference between investing and gambling. And in a choppy market like this, the gamblers get slaughtered.
Every single time.
We're coming to the end of our dive. I want to leave everyone with the outro wisdom from that OscarAI report. They have a motto. The market doesn't hate you, it's just testing you.
It's a very stoic perspective, isn't it? The market isn't malicious. It's just an indifferent machine that is designed to transfer wealth from the impatient to the patient.
And right now, we're in the extreme fear test. And historically, this is where fortunes are built. It's easy to buy when Bitcoin is at 125,000 and everyone on X is a genius.
Oh, yeah.
It is incredibly hard to buy or to just hold when it's at 70,000 and everyone says it's going to zero.
That's the cool head, hot heart concept. You need the cool head to look at the metrics we talked about, the stablecoin data, the whales, and realize the structure isn't broken. But you need the hot heart to actually execute on that conviction when your stomach is just churning.
So let's go back to our party. The smoke is thick, the alarm is blaring, most people are running down the street. The question is, are you brave enough to put on the mask, walk into the kitchen, and check the oven?
Because if the report is right and the house is still standing, the people who stay are the ones who get to eat the pizza.
And usually when the smoke clears, there's plenty of cold beer left in the fridge that the panic sellers left behind.
That's the best part of the contrarian trade.
Stay safe out there. Watch the data, not the drama. And keep your eyes on the whales. We'll catch you in the next deep dive.
Take care, everyone.